What is up, guys? Misha here from Beyond the Huddle, and welcome to another video. And today we're going to be answering the question: huddling versus trading, which one's better? Which one allows you to make the most money? So to do that, we're going to be taking a look at some of the pros and cons of each, and then we're going to be taking a look at some hardcore numbers. We're going to take an example of the rally that has happened between the low last year around March, April up to now, what kind of returns you could have gotten as a huddler, and what type of returns you could have gotten trading the way that we trade here at Beyond the Huddle, which is using the smart money. So without further ado, guys, let's get into it. So number one, huddling. What is huddling? It is basically buying and holding. Yes, it is that simple, guys. You pull up your phone, go on Coinbase, you buy whatever coin you want to buy, and then you put the phone down. That is basically what huddling is. Now, what are some of the pros of doing that? Well, pro number one, it's like I said, it's easy to do. It requires no skills. If you have a cell phone, internet connection, a computer, or whatever, all you have to do is buy and then do nothing else afterwards. That is huddling. Now, the second pro of that is that you never miss out on a major rally because you're never out of the market. You don't sell. So that means you're always going to be in on the rallies. Now, huddling also comes with some cons. And now let's go ahead and take a look at what are some of these cons. Con number one, you're going to have to endure some very large drawdown periods, especially during bear markets. Now, during the bull market, the retracements are usually about 30% or so. But during bear markets, the retracement on average for Bitcoin have been about 80%. So that means that if at the peak of the bull market, your portfolio value was 100,000, after an 80% retracement, you're left with $20,000. Now, I understand that 80,000 that you just lost, you didn't really lose it because it was paper profits. But at the same time, mentally, that will fuck with your mind. And that's why a lot of people can handle it, guys. A lot of people end up selling at the very bottom of the bear market, which creates capitulation. And that's exactly what we look for. Here at Beyond the Huddle, we look for people to capitulate in order for us to be able to buy at lower prices after a bear market. And that's one of the major cons, guys. Now, con number two is that you're going to be left holding the bag if your coin or project fails. That means if that project does not have the right people working on it, if something wrong happens and the project fails, then you're going to be left holding the bag regardless of how much money you were up at any given moment. So that's the con number two of huddling. So with that said, now let's take a look at trading. With trading, first off, we're going to have to look at the different types of trading. You have day trading, buying and selling in the same day. Short-term trading, buying and selling within a few days to a few weeks. Swing trading, which is our favorite one, and I'll explain why in a little bit. That one is buying and selling within a few weeks to a few months. And then you have position trading, which is buying and selling within a few months to a few years. Now, why do we like swing trading better? Well, there's a couple reasons. Reason number one, less frequency, which means there's less room for error, because every single time that you enter the market, you're putting capital at risk. You're risking being wrong and losing money. So the less you enter the market, the less likely that you are to take a loss. Now, that doesn't mean I'm afraid of the market, but that just means that I'm not having to deal with the little up and downs that happen on a daily basis. If you guys follow this channel, you guys know that we really stick to the higher time frames: quarterlies, monthlies, weeklies, and dailies, which is our execution time frame, the daily time frame. And that's pretty much what you're going to see if you guys take a look. If you guys watch the weekly breakdowns that Ralphie does every single Monday and Tuesday. So that's some of the reasons why we like swing trading. Another reason is that, and it's kind of the same reason actually, is with less frequency, you're going to spend less money on fees, right? If you're entering and exiting every single day, then you're going to spend a lot of money on fees because every single time you do a transaction, whether it's a buy or a sell, you have to pay fees to the exchanges. And so that's two reasons why we like swing trading. The third reason is because you're going to be able to make bigger gains. So for example, take within a bull market, you have a day trader who's entering and exiting within that same day, and you had a 15% day. Now the day trader will be like, damn, I just made a lot of money today. I made 15%. This is pretty nice. But what he doesn't know is that the market's going to keep on going, and he might not get an entry tomorrow, and tomorrow ends up being another 10, 15, 20% day. What happens is he's going to miss out on that 10, 15, 20% gain. Whereas as a swing trader, I'm still going to be in on that position, and I'm going to be able to capitalize and make some bigger gains. So these are the 3 reasons why we think swing trading is better than day trading or short-term trading. And position trading, there's nothing wrong with it, just not my cup of tea. I just don't have the patience to be holding on for that long. I need to secure the bag after a couple of weeks to a few months, guys. I can't hold on for years. So that is why swing trading is our preferred way of trading. Now, let's go ahead and take a look at some of the pros and the cons of trading in general. Now, pro number 1 is that you can take advantage of both bull and bear markets. And that does not necessarily mean that you are going to be shorting during a bear market, but that simply means that you're going to be out of the market during the drop. So that means you're not going to be losing any capital, and you're actually going to be able to buy back with more capital than someone that was hodling. And by default brings us to the second pro, which is that you're going to be able to make more money. Because think about it. If you're buying with more money at a lower price, then you're going to have more coins and therefore make more money on the next leg up. So these are the pros of trading. Now the cons is that it requires some skills. It is hard to do. It is not an easy thing to pull off. And you're going to have to learn it. You're going to have to gain the knowledge. You're going to have to practice. And then you're going to have to apply what you've learned. Now that brings us to the second con, which is that even if you know what you're doing, sometimes you're just going to read it wrong and you're going to miss out on certain moves, which means you might not be in during a major rally, or you might not see a major drop coming and end up losing some money. So those are some of the cons of trading. And guys, now that we've gone through the pros and cons of each, we're going to be taking a look at some hardcore data. We're going to take a look at one example from last year. We had the low that happened in March, April, and you guys can see I put some arrows of where a trader would have been entering and exiting. And you guys can see there's one entry in April, an exit in August, another entry in September, and an exit in April of this year. Now, I decided to not use the perfect exit or the perfect entry because I know nobody's going to have the perfect exit and the perfect entry. So I literally chose some sloppy exits and entries to make this more realistic. And we're going to be comparing what kind of returns you could have gotten from trading this way versus just being a hodler, entering obviously at the same exact price on the first entry and still holding on to right now at the current price of about 39,000. Now, these entries and exits are not random. I didn't just pick highs and lows and just put arrows on them. These are based off of on-chain data and smart money analysis using the COT and also price action signals. If you guys don't know what on-chain data is, I made a video about this last week about what it is and why you should be using it. And if you don't know what the COT is, there's also a video on the channel about the commitment of traders report and how it allows us to see how the smart money is positioned in the futures market. So if you need to know exactly what these things are and how you can use them, go ahead and check out these videos. And now we're going to go ahead and take a look at some of the returns that you would have gotten. Okay, so first off, we're going to be taking a look at hodler. What type of returns could you have gotten as a hodler? Starting balance is going to be $1,000. We're also going to use that for the trader as well. And your entry price is going to be at that weekly open of $5,878. Now, at that point, your exit, again, it's not really an exit because you're a hodler, you're still hodling right now, but we're going to assume you exited. That would be $39,000. And with that said, your profit is going to be $5,630.74. That is the profit that you would have made from buying at $5,878 and exiting at $39,000 without doing anything in between. And that gives you an ending balance of $6,630.74, which is about a 563% return. Okay, so this is the result that you would have gotten as a hodler, just simply buying at around April of 2020 and closing your eyes and waiting for right now, which is July of 2021. You would have had a 563% return, which is pretty good. You're not going to be able to do that in most markets. So if that's what you got, there's absolutely nothing wrong with that. This is pretty good, but that's going to be very, very different from what you're going to be getting as a trader. So if you were to actually go with the ups and downs of the market during that time, you're going to have some very, very different results. So let's go ahead and take a look at what some of these results actually would have been. So first off, we're going to be looking at a starting balance of 1,000 And with that starting balance, you're going to be entering at the same exact price of 5,878, which was the same exact price for the hodler. And with that, you're going to be exiting. Your first exit is going to be 11,653, which was around August of 2020. And again, these are some sloppy entries and exits, guys. These are not the perfect entries and exits at the absolute highs and lows. And now we're looking at an actual profit of $981.75. So that means that we're going to add this $981.75 to your initial $1,000 balance. That gives you a $1,981.75. Now that's your new portfolio. That's your new starting balance for your next entry. Your next entry that's going to come in around September of 2020, and that entry is going to be at 10,779. So at 10,779, you're going to be getting in with $1,981, which is almost double what you started with. So after that entry, your next exit is going to be at 49,123, which again is very well, I wouldn't say very far, but it's not the absolute high. Like I said, I did not just pick the absolute high as your exit. That's a pretty sloppy exit at 49,123. Now let's take a look at what kind of profit you would have had from that specific exit right there. Now that exit, you end up with a profit of $6,901.92, which again, that is from your second position right here. And that gives you an ending balance of $8,882.93. So from a starting balance of 1,000, now you come out with 8,000, which is about 2,000 and a couple hundred more than what the hodler would have come out with. And that gives you a return of 788%, which again is about 100, 200 something percent more than the hodler. So obviously, as we can see from the data right here, being a trader, being able to take advantage of the ups and downs of the market is a lot better than just hodling, just buying and hoping that prices would actually end up going higher. So with that being said, guys, hope you guys got some value from this. If you did, make sure to like, give it a thumbs up, subscribe to the channel. Please click the notification bell because we bring you guys some educational content like this every single week, and every single Monday and Tuesday. You guys already know Ralphie will give you guys the Bitcoin forecast and the altcoin forecast, looking at some of the on-chain data, looking at the commitment of traders report every single Monday and Tuesday. And also make sure you follow us on social media, Instagram, Twitter, Telegram. There's going to be links down below in the description. And also, if you guys are interested in our smart money analysis and you guys want to be able to understand how we're able to do this and learn how you can take advantage of these up and downs in the market, make sure you guys check out our free intro course. Link is also down below in the description. And with that being said, guys, hope you guys have an amazing rest of your day, and I will see you guys next week. Peace.